and welcome to the Vaibhav Global Limited Q4FY20 earnings conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone telephone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. Shiv Mattu from CDR India. Thank you and over to you, sir.
Thank you, Janice. Good evening, everyone, and thank you for joining us on Vaibhav Global earnings conference call for the quarter and year ended 31st March 2020. Today we have with us Mr. Sunil Agarwal, Managing Director, Mr. Vineet Ganeriwala, the company's CFO, and Ms. Dipti Rajput, DGM Investor Relations. We will begin the call with opening remarks by Mr. Sunil Agarwal on the business operations, key initiatives and a broad outlook, followed by a discussion on the financial performance by Mr. Vineet Ganeriwala. Following the management's opening comments, we will open the forum for Q&A. Before we get started, I would like to point out that some statements made or discussed on today's call may be forward-looking in nature and must be viewed in conjunction with the risks and uncertainties faced by the company. A more detailed statement and explanation of these risks is included in the earnings presentation shared earlier. The company does not undertake to update the forward-looking statements publicly. I would now like to invite Mr. Sunil Agarwal to start proceedings on this call. Over to you.
Thank you, Shiv. Good evening, everyone, and thank you for taking time to join us today on Vaibhav Global Limited's Q4 and FY20 earnings conference call. I wish you, your team, and loved ones health and safety. Before we move forward, I take this opportunity once again to welcome Vineet Ganeriwala, our new CFO, to the Vaibhav Global management team. Vineet comes to VGL with over 2 decades of rich experience across diverse industries and multiple geographies. Our erstwhile CFO, Mr. Puru Agarwal, will continue to be the part of core management team as President, Strategy and Business Development. With these changes, the management capital of VGL has strengthened further. This conference call, I would like to first talk about business continuity during COVID-19, followed by the performance during the year. The year 2020 began on an unexpected and a difficult note, with the entire world coming to standstill due to the spread of the pandemic. Economic activity, manufacturing operations, global supply chains have been disrupted and consumption patterns altered at macro as well as micro levels. Despite the uncertainties over the last few months, our retail businesses, that is, Shop LC in US and TJC in UK, have been operational throughout. Based on the announcements by the authorities in Texas, USA, Shop LC operations are part of the essential business category, and as per UK government guidance, online retail businesses are encouraged to remain open. Ancillary services like delivery services remain functional all through the pandemic at both US and UK. With customer at the heart of the business, we rapidly augmented product offering across our omni-channel sales platform to include over 250 essential products, including masks, sanitizers, health supplements, kitchen accessories, coloring books, board games, etc. This enabled us to deepen our engagement with existing customers while expanding the new customer base. In addition, the traction on our retail platforms is supported by shutdown of traditional retail in line with social distancing guidelines. To ensure undisrupted call center functioning, the entire call center was moved to remote workforce. We also initiated auto-routing to outsourced call center to reduce the wait time. The integration of 5.9 software into our IVR system that we undertook in Q2 provided strong support for managing high traffic on the platforms in recent months. Robust IT infrastructure helped create a borderless workforce to support business globally with no latency. As a contingency plan, we built remote TV production and broadcast solution to ensure continuity in operation should the campus not be accessible due to the lockdown. Coming to the supply side of business, our global supply chain consists of wholly owned subsidiaries in key sourcing geographies of India, China, Thailand, and Indonesia. Over the past 1 year, the tenacity and immense value of robust supply chain has been put to test several times on account of external exigencies, including the US-China trade war and the current pandemic. It is noteworthy that the supply chain has consistently delivered with prudent time to market and efficient product sourcing, providing solid support to our B2C model. Coming to the specifics, there was a temporary shutdown in China at the start of the year, resuming operations on March 2nd, 2020. Units in other supply countries picked up the slack during that time. A lockdown in India led to temporary closure of Indian operations at the end of March, resuming partial operations on April 27, 2020. China, Thailand, and Indonesia filled the void during that time. We have been adhering to all the directives issued by government authorities across our global operations. Now, more than ever, our commitment to all our stakeholders remains unwavered. With the well-being of our team at the core, we have undertaken appropriate precautionary measures to ensure safety and health of all our employees. Stepping up the situation, we realigned our business to meet customer needs through uninterrupted supply of essentials. As an expression of gratitude to frontline healthcare workers, we donated approximately 127,000 masks to approximately 200 hospitals, care homes, police stations, and even grocery stores. Extending support to the government in India, post announcement of lockdown, VGL donated approximately 1.6 million meals to migrants and people in need through Akshay Patra in Jaipur, India. Overall, through our flagship CSR initiative, the 1-for-1 program, we have provided nearly 37 million meals to school children across India, US, and UK since its inception of our 1-for-1 program about 5 years ago. Let me now take you through the operating performance and key initiatives during the quarter under review. I'm glad to share that our global operations have been delivering on both societal as well as economic goals. On constant currency basis, Shop LC US marked the growth of 9% year over year, and TJC UK marked the growth of 17% year over year in Q4 FY 2020. Despite high returns witnessed during the quarter due to COVID, the company reported strong profitability. We remain focused on strategic objectives of expanding the 4 R's underlying business performance. That is, widening reach, growing new customer registrations, improving customer retention, and increasing repeat purchase. Successes on these parameters have resulted in increased market share, higher margins, and strong cash flows. In Q4 FY20, the number of TV households in our coverage stood at 99 million as compared to 100 million in the same quarter last year. Unique customers for FY20 at 361,515 increased from 342,599 in FY19. Average annualized quantity purchased by each customer in trailing 12-month basis is stable at 30 pieces per customer. Customer retention rate stands at 50% and is steadily improving. Revenues have increased at CAGR of 12% between FY16 and FY20, while EBITDA has increased at CAGR of 39% during the same period. EBITDA margins have improved from 5.9% in FY16 to 14% in FY20. This has led to strong cash accretion, steady improvement in return ratios, and growing payouts to shareholders. I am pleased to share that our board of directors approved a special interim dividend of rupees 19.74 per equity share during the quarter and have recommended a final dividend of rupees 7 per equity share now. In the current financial year, FY21, we continue to deliver secular growth in the world where last mile delivery has become the new normal. The current industry disruptions will cause long-term shift in consumer behavior leaning towards home shopping formats, including TV and web. The ability of retailers to transform and adapt with agility will define their chances of survival. At VGL, we believe this is an opportunity to serve our customers with products offering that meets wants and needs. And given our strong operation and financial standing, we will emerge even stronger on the other side. As per IMF World Economic Outlook projections, US output is expected to decline by 5.9% in 2020 and improve by 4.7% in 2021. UK output is projected to decline by 6.5% in 2020 and improve by 4% in 2021. Our current business model emerged during global financial crisis of 2007-2008, when created a niche for ourselves as a deep value discounter. Since then, we have been committed to our core, which serves us well, especially in adversity. The current times favors those who offer deep value for money, and the segment we cater to will only expand further given our value proposition. Given the company's resilient operating structure and agility, in the medium term and short term, we expect revenue growth to grow by 15 to 17% on constant currency basis for our B2C business, with consumer rate operating margin leverage owing to a relatively fixed cost base. To conclude, I would like to express my sincere gratitude to VGL team, our customers, suppliers, for all the support, and a special thanks to the frontline workers across the globe. With that, I now hand over the forum to Vineet to discuss financial performance for the period under review.
Thank you, Sunil.
Over to you, Vineet.
Thank you, Sunil. Good evening, everyone, and welcome to Vaibhav Global Limited's Q4 and FY20 earnings call. Hope you and your near and dear ones are safe and healthy. I'm glad to join you all on my maiden earnings con call and will take you through our financial performance for the quarter and full year ended 31st March 2020. As stated previously, effectively 1st April 2019, the group adopted the new accounting standard for leases applied to all lease contracts existing on April 1, 2019, using the modified retrospective method, and has taken the cumulative adjustment to retained earnings as on the date of initial application. Accordingly, group is not required to restate the comparative information. A detailed note related to the said accounting standard has been shared along with the results table published day before yesterday. Rapidly adjusting to the new normal, we balanced safety and business to deliver positive results. Revenue have improved from rupees 462 crore to rupees 498 crore year on year during the quarter under review. For full year FY20, revenue increased to rupees 1986 crore compared to rupees 1814 crore for FY19. As you would know, the retail or B2C business has been our key focus. This currently constitutes about 97% of the total revenues. We operate our proprietary TV and web-based platforms for direct customer outreach, and this business grew by 14% year-on-year for the quarter and 15% year-on-year for the full year. We witnessed healthy growth in both the geographies. On constant currency basis, Top LC US grew 9% year-on-year for the quarter and 13% year-on-year for the full year, while TJC UK grew 17% year-on-year for the quarter and 19% year-on-year for the full year ended 31st March 2020. Towards the end of the quarter, we witnessed increased return rates owing to some nervousness in US around the pandemic. Mapping customer feedback with business results, we promptly shifted the product mix to cater to the current requirement of our customers. With agility, we introduced essentials while exploring future opportunities in this segment along the way. As early adopters of the omni-channel distribution model, VGL continues to build a deep commitment to its customers through the diverse channels of television, web, mobile apps, marketplaces, social media platforms, and several new age digital platforms. This integrated model allows cross-referencing of customers, which favors business growth as the lifetime value of an omni-channel customer is meaningfully higher than a web-only or a TV-only customer. TV revenues grew by 16% year-on-year for the quarter and 11% year-on-year for the year. Web revenues, on the other hand, grew 10% year-on-year for the quarter and 24% year-on-year for the full year. Within web, mobile sales constitute around 60% of the total web sales. Although we continue to report TV and web sales separately, it is important to remember that both these channels are rapidly converging from the customer's perspective to create a symbiotic ecosystem. Over the past few quarters, we have scaled down the B2B business as we consider it more opportunistic and not core to our longer-term objectives. During FY20, we registered revenues of rupees 69 crore in this business compared to rupees 147 crore in FY19. Over the years, VGL has created a robust supply chain with manufacturing and sourcing operations across US, Asia, and Europe, supplemented by some product ranges sourced locally in the US and UK. We are the only company in the peer group that has its own manufacturing setup in addition to the direct sourcing offices that operate without the intervention of external agents. This allows us substantially high gross margins at around 60% levels. We have maintained such margin over the last several years across an expanding portfolio of products. Gross margin came in at 60% for Q4 and 62% for FY20. During the quarter, EBITDA improved by 29% year-on-year to rupees 60 crore and margins expanded by 190 basis points at 12%. For full year FY20, EBITDA came in at rupees 276 crore, growing 27% year-on-year compared to last year, and margins increased by 190 basis points to 14%. PAT was rupees 40 crores for the quarter, increasing by 22% year-on-year, and margin improved by 100 basis points to 8%. For full year FY20, PAT was rupees 190 crore, expanding by 23% year-on-year, and the full year PAT margins increased by 120 basis points to 9.6%. During FY20, we incurred capex of around 35 crores, attributable mainly towards purchase of an adjacent factory building in Jaipur for rupees 6 crore, investment of 4 crore in solar power plant, and a balance towards global ERP and equipment and furniture at new warehouses in US and UK. Our operating model remains significantly cash accretive. Operating cash flows for FY20 stood at rupees 211 crore and free cash flow stood at rupees 176 crore. For the fourth quarter, we reported operating cash flows at rupees 68 crore and free cash flow of rupees 61 crore. Our return ratios continue to expand. Return on average net worth came in at 26%, whereas a low debt structure allowed return on average capital employed to improve to 46% for FY20 as against 37% for FY19. While concluding, I would like to say that we have delivered strong performance amidst the ongoing pandemic and a stressful environment. This was primarily on the back of proactive measures taken by the management, supported by our strong balance sheet. Going ahead, we will continue to rationalize costs across all business functions and geographies while maintaining a healthy balance sheet. We are also confident of continuing our operating momentum and remain optimistic about optimistic about the business. With that, I conclude my opening remarks and request the operator to open the forum for questions.
Thank you very much. Ladies and gentlemen, we will now begin the question answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Mukesh from Lucky Investment. Please go ahead.
Yeah, thank you for the opportunity and hope everyone's safe at your end. Sir, first question is, there's this interplay of, lowering volume growth, higher realization, but a lower GM, gross margin. So how should we read that and what should be the course direction here? Because the GM is down about 100 basis points for FY20 and whatever 200 basis points in Q4 with a plus 10% type realization growth. So if you could, throw some light there.
Thank you for your question, Mukesh. As I mentioned in earlier calls also, we look at our business model as very agile. So we look at what customer is pulling from us. If it is a higher price point, we offer slightly higher price point, but within our guidance of being a value retailer and approximately half of what other retailers are. So we have a certain range within our company. So we operate within that range from the price point perspective. And the volumes are driven from the price point. So this customer has certain budget or some amount in their mind. If they reach that level, then they may not go higher than that. Your next point about the gross margin. Our aim is to constantly monitor the gross margin to stay above 60%. And from above that, if there is a 1 or 2% margin movement, we don't pay so much close attention because we have such a varied product line. Just to give perspective, we launch about 150 new products every day and with different margins in different products. So in a business like a cement or Parle-G biscuit, it's a very few SKUs. And we can maintain a certain constant margin within those limited SKUs. And our SKU base is very immense. So margin can vary a bit, but as long as we maintain above 60%, that is our internal guideline.
So that that explains. So I was a bit worried if the gross margins keep on going down, then there is a ceiling on the EBITDA margin or the operating leverage play. But since you're saying that 60% is what you would look at and not go below that, then the business model has a scope for operating leverage.
Correct.
Okay. My second question is, now there is an interplay of recession in the countries that you are operating, and there is this direct payout which have been given to the larger population there. So considering these two divergent elements, what do you think should be the course of business for the current financial year?
So we are giving guidance of 15 to 17% top line growth in combined business and corresponding operating leverage will be there.
Could you throw some color in terms of is it a customer pulse or any other data point that you're relying on for a double-digit growth?
So as I mentioned earlier in my opening comments about our 4R. So first is the reach. So we continue to expand the reach through TV, through television by way of having additional simulcast channels, through OTA markets, which is over-the-air antenna markets, which is expanding quite rapidly, through OTT, there is over-the-top on streaming platforms, through marketplaces, there is Amazon, Walmart, eBay, and Wish, and through social DR. So we are continuing to expand the reach, and the next is acquiring more and more customers. So during the pandemic and during the last couple of months, we've seen the new customer acquisition has been higher than normal due to essential products that we aired. So as I mentioned, we have aired about 250 new essential products which are new to the business, and that has attracted a lot of customers, and we're trying to transition those customers to the main business. So far, transition rate has been in double digits, and we're trying to increase it to higher double digits. And the third is retention. So we are constantly improving the retention. So we are standing at around 50% now, and we are hopeful to improve that slightly over the years. And the last fourth is repeat purchase. Our repeat purchase is approximately 30. With new advent of customers they're coming in for essentials, it may not go up substantially during the year. In fact, it may go slightly low. But all these factors, 4 factors combined, gives us confidence that we'll attain 15 to 17% growth. In fact, the current quarter may see slightly higher than that, but the next quarter may see slightly lower due to US election. But for the current financial year, we're fairly confident of 15 to 17% year-over-year growth.
Okay. Have we formulated a payout policy for us? Last year, the PAT payout were fairly high, even considering the buyback. So, have we formulated a dividend payout policy?
Vineet, you want to mention?
Yes, Sunil, I'll take that. Yes, we have formulated a dividend payout policy, and that has been posted in the website today as well. So our endeavor is to distribute to the shareholders 20 to 30% of our free cash flow for the year. Of course, board, while recommending or approving dividend, will take into account the other circumstances and may give special higher dividend or at times a lower one. But as a general, the endeavor would be to distribute 20 to 30%. And if you look at the payout of the last year, the interim and the final dividend which the board have now recommended, both added together is about 25% of the total free cash flow for the last year.
Okay. And lastly, sir, the UK business, until last year was not profitable, or let's say low profitable and generating extremely low cash flow. So, what is the update specifically on UK business because in terms of the profitability and the cash flows? That's my last question.
So UK has been growing very well, between 17 to 20% year over year. As I mentioned in my opening remarks, UK grew 17% for the quarter and 19% for the year, for the last financial year. And we expect the growth rate to be similar or higher in current financial year and coming years as well.
No, my question was on the profitability there, the margin profile and the cash flow.
So I don't have exact gross margin. Gross margins, is overall very strong. But profitability, we don't split separately from the EBITDA perspective. Vineet, do you have more information on that?
So UK business have been profitable since last many years, like 3 to 4 years. It have been quite profitable, and right now is sitting at a very healthy EBITDA margin. But like Sunil mentioned, we don't report the profits number for the both entities separately and only report the consolidated one. But yes, it is quite profitable and generating healthy cash.
Okay. Thank you and all the best, sir. Thank you very much.
Thank you. We take the next question from the line of Vikrant Kashyap from KDR Securities. Please stop.
Good evening, sir. Hello.
Good evening, Vikrant.
Yeah. So my first question is, what is our mix of jewelry and non-jewelry segment, and how do you see it panning in next 2 to 3 years?
Sure. So currently, jewelry is approximately 78% or 78 to 80% in US and about 58% in UK. The rest is non-jewelry. And over the years, the non-jewelry will continue to grow up as we find product categories that gives us more profitability or more per minute revenue and per minute margin compared to jewelry. And what we look at per minute productivity ratio, that consists of margin, new customer acquisition, and overall consolidated revenue. That includes the shipping revenue and the product revenue. So we look at all these product mix, which is combines into our metrics productivity ratio per minute. And we constantly look at that metrics productivity ratio, and based on that, we take the decision of addition of a product line or exit of a certain product line. And so we don't have a certain target for that for the long run. We let each category earn its space into our product mix.
Okay. You also mentioned in your opening remark that you are looking to serve your customers with new product that serves their needs and wants, right? And we have seen books as a category in Amazon and likewise other channels. It is a big market for the online books. Have you considered adding it to your product catalog?
So online book is a very traditional category and only suitable for very large players like Amazon or Borders. For us to get into that competitive product category may not allow us 60% gross margin that we have in the guidelines.
Okay.
So, but we do continue to monitor the additional product line, as I mentioned in my opening remarks. That during pandemic, we found that the coloring books received great traction. Board games received great traction. Supplements, the vitamin supplements were accepted very well. So we'll continue to monitor these categories, and if they stand test of time after pandemic, we'll continue to expand them. But our guiding principle is we have the 60% gross margin, and each category must make its space by way of metrics productivity per minute.
Okay. So you are driven by these 4 factors. And you also mentioned about increased return ratios in US. So what are they right now and what were they earlier? And do you think it will impact on your performance anyway going forward?
Right.
Yeah. So returns in US does hover around 18 to 19%. In UK as a country, it is little higher and hovers around 26-27%. In Q4, we saw an increase of about 2 to 3% because of this nervousness due to pandemic. But in the coming months, like in the current month, we see that it has again stabilized. So we don't foresee the return percentage to continue increasing further, but it's again back to the normal return percentages which we saw in the last year.
Right. We also talked about our increased focus on marketplaces along with OTT and OTAs, social media also. Have you seen any traction, or have customer engagement has improved, or have they started coming to our own platform from the likes of Amazon and eBay?
Yes. So the business has rapidly increased on the platforms. So just to give an example, in 2019-20, the business was approximately 120% more than the year before. And in the current financial year also, we are seeing such kind of growth on the marketplace. It's a small base, but we are still seeing a tremendous growth. The customer transition from marketplace to main business is still low single digits, but even that is meaningful because when the customer comes to the main business, their buying patterns are similar to our own acquired direct customers for digital platforms.
Okay. My last question is, why our sales growth on web has been only 10% this quarter? But it has been rapidly growing quarter on quarter, year on year. Is there any that you can, please?
Only for Q4, there were 2 factors. One was the year before, we had done massive promotion on our e-com platforms, so that had high base.
Okay.
And second is in Q4 there was a nervousness in overall business that reflected on lower overall growth rate. But we are quite confident that in current financial year, our e-com growth rate will be north of 25%.
North of 25%. Okay, sir. Thank you very much, and wish you all the best.
Thank you. Next question is from the line of Akash from Motilal Oswal Securities. Please go ahead.
Yeah, thanks for the opportunity. So I have a couple of questions. First is on when we speak about, let's say, growth for more than 15% for the year. So this year is, I would say, a special year because of the ongoing pandemic. And since we are selling essentials now, growth could also be driven by the essential category. So I wanted to understand whether the outlook of 15% will stay for fashion jewelry and fashion accessories as well.
So we give a growth projections of overall for the business, Akash. So essentials are just approximately 15% of our business right now in the pandemic. So it's not massive, but what it has done is it increased engagement with our customers tremendously. For example, if we sell them essentials like masks or sanitizers, they really thank us for bringing it to them. And combined that, we give donations to the hospital and police station and care homes. So that that improved the engagement substantially. And new customer acquisition that we did this year has also helped because of essentials. That will continue to help for many years to come. So as I mentioned earlier, our growth is not just because of essentials; it is because of 4 R's: reach, registration, that is new customers, repeat purchase, and retention. And we continue to focus on all these 4 levers, and we have a long way to go. Just to give a perspective, QVC's revenue per home in US is about $60. Our revenue per home in US is $3. So we have a long runway in front of us. We are a small player, very nimble, and low cost structure.
This is a new category for us, the essentials, which we have started, let's say, in the last 2 to 3 months. So if we take a longer view, let's say 1 to 3 years, would it remain, let's say, in this 15-20% range, and whether in terms of gross margins it would be meeting the company criteria of 60%?
Yeah, it is meeting the company criteria. There are some very low margin that we bought for the customer engagement, like pasta and rice, but they are hardly 0.1% of sale. But the other essential like board games or coloring books or vitamin supplements or sanitizers and masks, they are giving 60% plus our regular margin. So overall, essentials are giving our metrics productivity requirements. So in long run, if they continue, that'll be great. But we don't expect the essential to continue 15% or so. We expect the other product categories, as people become more relaxed, they continue to engage with other productivity like our lifestyle bags. Right now, people are not buying bags because they're not going outside. So the bags will start to take up when people start to go outside. The jewelry is more low price point right now, but as the people become more relaxed, they'll start to buy mid price point or a little high price point from us. But we are quite confident of our growth projections that we've given to you.
Okay. And lastly, I think we have been having spectacular results, so good results since last few quarters and years. And so in FY20, if I include the buyback as well, we almost distributed 150 crores in terms of dividends and buybacks, which is almost 80% of PAT and more than 50% of cash flows. And as it was mentioned now that we are looking at a policy of 20-30%. So that way, going by the past year, why are we contemplating a decline in the payouts? Because FY20 was really fantastic at almost 80% payout to the PAT.
So that's a good question, Akash. Our endeavor is to have certain cushion of cash in the company if certain opportunity comes our way. Although we are not actively looking for M&A opportunities, but we want to create certain cushion in case there is an opportunity. But if we don't see opportunity like we didn't see last year, we paid it out. So we'll continue with similar practice in the years to come. If we see the opportunity, we'll utilize the cash. Otherwise, we'll pay it out.
Okay. Thank you. My questions are answered. Thanks a lot and all the best.
Thank you, Akash.
Thank you. We take the next question from the line of Chintan Seth from Samiksha Capital. Please go ahead.
Yeah, thanks for the opportunity. Sir, on the sales through EMI options, how that has performed and any delinquencies we have faced because of this nervousness in the market?
So our EMI sales is around 40 to 45% of our total sales is on EMI. And during pandemic, since our amounts are so small, so we have not seen any delinquencies during this pandemic. It's been now more than 2 months, and we have not experienced any such thing.
Okay. And
only adversity that we experienced was a high return rate. So that started to come in March, continued in April, but that was towards what people purchased for Q4, and that we have fully accounted for in our books.
Right. And on the contracts with the TV, broadcasters, how we are seeing any improvement, or how the negotiations are going on right now, given the weak environment currently?
Yeah, so it's a constant thing that we do. It's a constant negotiation that we do. It's a weekly review of all the marketplaces. We do the weekly review, and wherever we find they are not performing to their potential, we negotiate it down. If there's no negotiation, then we exit that marketplace. So overall, it's a continuous review, and we are not seeing any material change in that space.
Okay, but you mentioned during the initial remark that we are kind of converging between our web and online e-com side, be it TV and web are getting converging that way. So given the scale up of our website, do we foresee any curtailment in terms of TV spends going forward, and that will push our EBITDA margin further higher compared to what we are currently reporting?
So for most of the markets, we pay a flat fee of the entire platform. So whether we sell $1 per home through their platform, or we sell $10 per home, so it's a flat fee. Some platforms have per home basis as well. So if there is a cord cutting happening on that platform, then that will be reduced. But correspondingly, when the OTA is improving rapidly, increasing as a market size, and so that also we have to pay per home, so that will increase on the other side. So in long run, we are not seeing any material change on airtime basis. My comment about converging of TV and platform, TV and web, was to the fact that our business model is such that it covers both the spaces. I'll give you an example. We have an online auction platform within our web, where we start everything at $1, and people compete against each other, and they bid against each other, and it reaches whatever price it is. $1 starting reaches, say, $15 or $20. But there is mostly the exit of our TV product. So the small tails or dogs which are not doing well on television, not worth the airtime, so that we liquidate through this model. So that means the web and television are very symbiotic. And also on the web, we have a TV streaming. So all the TV stream is streamed through web. And there's a good amount of revenue coming through that channel as well. But there's a TV broadcast seen by people who don't have cable subscription. Or say some people have a subscription, they refer to their daughter or their sister in another city where they don't see our cable, then they would consume it via web. But there is again symbiotic between television and web. Now the third is FPC platform on web. For that, we constantly promote on our television. If there's a discount on web, TV hosts will encourage customers to go on web and take advantage of a promotion. So again, there's a continuous convergence of these models, and there's a symbiotic relationship between two models.
Right. And lastly, on the US household data you pointed out just a bit earlier, is there any category you are focusing on? Is the entire household universe for the US and UK that you kind of indicating? Is a specific, say, urban or rural, or some portion of the US market which is more relevant to you, or it's a broad-based household you are indicating?
So for our television, signal, it is uniform all across the US. So we must source a product which is suitable for large population of the US. For our web, we have the ability to geographically segment the product feed. We have the ability, but we haven't really fully utilized that segmentation yet. That is in the offing right now. We are investing our resources in that space, but we haven't taken advantage of that capability yet.
Mm-hmm. So basically, the cable household will be a good number to start with for us in terms of number of cable connections per household in US. That will give a broad indication what you mentioned about $30 versus $3 we are at right now.
So 3 versus 60, that is correct. Yeah. So that will be a good indicator. Now you have to take into account the paid cable as well as unpaid OTA market. Both are addressable for us. So cable paid homes are going down slowly, but OTAs are coming up year over year.
Sure, sir. Thanks for the clarification, John McKinney. Thank you.
Sure.
Thank you. We take the next question from the line of Ashish Kacholia from Lucky Investment. Please go ahead.
Good afternoon, sir. I have two questions. One is that our B2B sales have gone down to almost negligible levels. Are we to understand that it is no longer a focus business for us, and these are the levels at which the B2B revenues will continue forever?
Yeah, so B2B is still, as Vineet mentioned, it is opportunistic for us. And when we look at an opportunity, or we need to exit certain product line, for example, say if we buy some auction or some semi-precious material, and we use certain grades for that, the rest will exit into this opportunistic market. They've already exited the B2B sales to Macy's or to Evine or QVC that we used to sell. So that business has been exited. But there are certain customers like QVC Germany or 123 Television or certain other television markets, television companies that we sell directly from our India or China offices. So that will continue for if that continues to offer us appropriate ROI.
So it may not go up much from the current quarter's levels, whatever.
We don't foresee at this time.
Right. So that was one. Secondly, sir, you have just opened. I just saw your shop LC on Instagram. So what's the initial response of customers on this stand?
So Instagram is a great initiative. Thanks for asking the question. So we started about 5-6 months ago influencer program on Shop LC. So we partnered with a platform called Pixely. Pixely has about 250,000 influencers registered on Pixely platform. And our team is reaching out to hundreds of those influencers to post our product to their followers. For that, for some of the influencers, we have to send our box to them of a product free of charge, and then they take the picture of that jewelry or accessory on them, and they post to the followers, and they get the box for free in return. Some influencers are for revenue sharing. So whatever revenue they will generate, we will share that revenue with them. So that is a very exciting platform for future growth. We also contracted another platform called TV Page that also has ambassadors and influencers linked to the platform whom we can tap for our growth of the business. So far, the revenue is small, but this offers much exciting avenues for our company's future growth. And we're dedicated people, both in US and UK, for that platform to take forward. Some very capable people.
Okay. And what about TikTok, sir?
We have not done anything on TikTok yet. So this is still a new platform for us, Instagram and Facebook, and we want to leverage that and get a traction there before we take up any new platform. But thanks for the suggestion, Ashish. I'll keep that in mind.
TikTok में क्या 1 minute का video होता है, and it is like, I think it is a really buzzing platform from the low price point merchandise point of view.
Yeah. So TikTok is very popular in India and China. US and UK has not caught up as much as Instagram or Facebook, but I'll definitely explore that. Thanks for sharing.
All right, sir. Thank you so much, and congratulations on a great set of numbers.
Thanks, Ashish.
Thank you. Next question is from the line of from trendlyne.
Yeah, hi. Thanks for the opportunity. Couple of questions on Q4 results, and then probably I'll go to FY20 results. Q4, so if you can quantify the impact of COVID-19 in terms of revenue or in terms of EBITDA, that would be helpful because if I see that there has been some impact in terms of margins. Gross margins have come down from a quarterly run rate, and also the EBITDA margin is not up to the mark if I see. So if you can quantify the impact of COVID-19.
So I don't believe we have separately quantified the COVID impact on the business, but I can give you qualitative information. One is that we paid some extra incentive to our warehouse employees in both US and UK to come. So there was $2 per hour that we paid to them. Anybody else who came for like studio staff or IT staff or some merchandising staff who came into our buildings, we paid extra incentive to them both in US and UK. I don't have exact number how much that spend was. Second thing is the return rate increased that we need to mention and give color on. Both in US and UK, the return rate increased in March and April. That we accounted for all in Q4 because whatever was accounted, whatever return came for that period, we accounted for as per the standards. So I don't have exact numbers, but what I can share with you is that current financial year or even current quarter, we will see 15 to 17% constant currency growth for both combined businesses and the corresponding leverage for the business and minimum 60% gross margin.
So maybe to add, Sunil, we don't see a EBITDA growth decline in the quarter. So Q4 EBITDA growth year on year was 29%, which is quite similar to the earlier quarter. So while we see a return impact, but we have been managed well to offset by our cost optimization, which we launched in the last quarter, and we don't see a EBITDA impact.
No, that's fine. I just meant that, if I adjust for the Ind AS impact, your EBITDA margin for the quarter is 10.4%, vis-a-vis the run rate of last 3 quarters of around, 15%, 13%, much higher. So that was, I thought that maybe some impact due to COVID-19. Okay, fine.
Part of the margin is also seasonal. So if you look at Q4 over Q4 of last year, we did expand by about 120 basis points in terms of margin. And even if we adjust the lease impact out of it, I guess the margin expansion is still 100 basis points in the quarter.
Sure. Second question on the consumer behavior. As Sunil mentioned that, there are almost 250 essential items that, you have rolled out, and the customer engagement has been terrific. Is that something to do with the gross margin dip, a little bit of dip that we have seen in the quarter? Because, most of these items would be, I guess, traded, if not manufactured. Is that a correct understanding?
So as I mentioned earlier also, that our gross margin on essential as a category is 60% plus, similar to our overall business requirement. So the essential has not impacted the gross margin as such. What might have impacted in Q4 slightly was that we ran clearance in both US and UK, and we discounted products slightly more owing to the environment. And our essential had not landed with us at that time. So they started landing with us. So some essentials had landed, especially in UK. US started seeing some essentials coming into us around to the really fag end of quarter. So essential didn't impact, but extra discounting in jewelry to keep the momentum going.
Okay. On the guidance of 15 to 17% constant currency growth, your FY20 B2C revenue growth, if I see, is 15% approx. And if I remove the currency part, what is your average USD relation, USD INR, if I may ask?
So as I mentioned, in US, In US, we grew, I believe, 13% for the full year and 19% for full year in constant currency basis. Yeah, 13% in US and 19% in UK in pound terms.
Yeah, I mean, both put together, I think that's approximately 14.5%.
So it depends on what currency you put in. If you put in US dollar, it probably will be around 14. If you put in pounds, it will probably be around 16%.
Okay.
Because pound devalued against dollars. But when you convert them in rupees, it was 15.1% growth year over year for the B2C revenue.
Yeah, 15.1%. So my question was, 15 to 17% constant currency growth that you are guiding. Is it volume led or is it ASP led? Anything if you want to put a color on that?
So we don't want to emphasize too much on our volume because, as I mentioned earlier, we let the customer dictate what they want to pull in at any given time, and we are very agile in terms of bringing the right product what customer is looking for, as we demonstrated with Essentials in our Q4 and now coming in current quarter. So it may move a little bit. So I would encourage you to look at in total terms of dollar revenue in constant currency terms. So if you want to create a model, and if your model is volume led, I would encourage you to look at the model of whatever average price point of last year was. So for the model perspective, the volume and current or revenue increase will be same.
Yeah, the reason why I asked is, your ASP has actually, seen a dramatic increase, especially if I look at the TV ASP, almost touching $30, $29, $30. So do I expect it to remain in the same range in FY21 as well?
So current quarter, the ASP is lower than what you saw in last quarter or last year because of Essentials. But again, I don't want to give guidance on ASP. What I request you to keep the total overall margin of 60% plus, and the revenue growth of 15 to 70% at same ASP as last year.
Sure, thanks. Last question on the net addition of customers, unique customers, if you can just provide for the quarter and full year.
So I shared the total year numbers with you, but quarter number we need. Do you have the data in front of you? So year number I shared was 351,915 in this financial year, 2019-20 versus 342,517 in FY19. So there was an increase of approximately 20,000 customers.
Yeah, so in the quarter, the unique customers increased by about 6.6% for the quarter. Q4 FY20.
6.6%. And if you can help me with the number in Q4 FY19 so that I can get the Q4 FY20.
So our unique customers for Q4 FY20 was 178,000, and for Q4 FY19 was 167,000.
Okay. Thanks. Thank you.
So one thing to keep in mind that we give unique numbers in trailing 12-month basis. So even for the 361,915 number is trailing 12 months. So even when we give, this is the end of the year, so it doesn't matter. But even for next quarter, when we give this number, it's on trailing 12-month basis.
Understood. Thanks.
Thank you. We take the next question from the line of Sunny from Securities. Please go ahead. Okay. First of all, congratulations, sir, for the excellent set of numbers. My first question would be, so how do you see, do we see a change in consumption pattern given the current pandemic situation, and given the fact that approximately 70% of the revenue is generated from these fashion jewelry items? Despite the fact, even though we are 15-20 coming from this essential category, but how do we see it, because we're already projecting a growth of 15-20%? And the second question would, so if you could just answer the first one.
Yeah. So as I mentioned earlier also, we are seeing a good traction on the lower price point jewelry and accessories. So, for example, there are many jewelry that people want, faith jewelry right now. Crosses or rosaries have started to sell very well. Or jewelry with love, affection, like charm bracelets and jewelry which is family denominated has started to sell well. So since we are very agile, we go with what the customer is looking for and we get to the customer very rapidly. So this kind of jewelry, emotion jewelry is doing very well. The investment pieces are not doing very, very well right now. So we have reduced the airtime devoted to that kind of product. So lower price point and mid price point are doing well. And if the economy goes back to a strong footing, we'll bring those higher price points back up again and bring those handbags back up again. Handbags are not selling right now. For example, earrings are selling very well. Earrings are selling very well because people are doing Zoom meetings. So earrings are visible, but not as much as, say, rings, because rings are not as visible on Zoom meetings.
Okay, sir. So, sir, just a question on this. So the low price products, these jewelry items, they have a similar margin as that of the high price products?
Correct. They have similar margin.
Okay. And just one last question. That is on the supply chain side. You said that you had supply chain issues in India due to the lockdown, but that was partly offset by your other subsidiaries, say in Indonesia, China, and other places. So are these subsidiaries exactly complementary to each other? So if one is not able to supply anything, that could be compensated by other subsidiaries, or how do we look at that?
Yeah, so we are able to source from those countries as well, from outside vendors as well. Only India is our own factory. Rest, all these three locations are outsourced model. So we can source products that are suitable for customers at that time. They don't replicate exactly, but our agile business model allows us to modify the product offering to the customer. If we were selling Parle-G biscuits, then it will be difficult. But we are very agile in terms of what we can offer to the customer at a certain point. Just to give an example, the essential like sanitizers or masks or board games or these kind of products came in from China during pandemic, and that worked very well for us. And products like turmeric or amla powder or cinnamon powder that came from India. Even during lockdown, we were able to ship those products because they were essential products. We were able to ship them from India, and that did very well for us. So we are very agile in terms of what product the customer needs, and we are able to modify our offering based on what they are needing and what we are offering.
Okay, and so just a repeat question. So even in the outsourcing, while you outsource products from these other factories, you enjoy a similar kind of margin?
Correct.
Or the margin that was... Okay. Thank you. Thank you. We take the next question from the line of Chintan Sood from Sametra Capital. Please go ahead.
Thanks for the follow-up, sir. Just a clarification on the essential products which you introduced this quarter. You said it contributed around 15% to the revenue in 4Q.
Correct.
Okay.
Not Q4, sorry. Q4 was just about 3 to 4%. But there is current run rate. So in current
run rate is around 15%. Okay. So adjusting, even if I adjust that, growth will be slightly lower, not material lower. Okay, that's one.
We are very confident of 15 to 17% growth in current quarter and current financial year, or even midterm, next 2 to 3 years as well.
Sure. Okay, thanks. Sir. That was the only question I had. Yeah.
Sure.
Thank you. We take the next question from the line of Mukesh from Lucky Investment. Please go ahead.
So just clarification, you mentioned that the web growth rate will be 25%, e-com growth rate, when you were mentioning e-com growth rate 25%, so that refers to the web, right?
Correct.
So now in this, the portal and everything will get included, right? The marketplaces, the social media portals, everything will be included here, right, as e-com growth rate?
Correct. And this is minimum that we expect. it will be north of 25%.
Okay. And my second clarification is you were mentioning one figure as $60 per household and you are at $3 per household. I couldn't catch what you were actually referring to.
So QVC's revenue is about $60 per household.
Okay.
QVC US. And Shop LC US is about $3 per home.
Okay, understood. But let's say in the jewelry category, any further breakdown if possible within jewelry category, how they would be and how we would be stacked up?
We do not know the exact jewelry number, but we are mostly looking at per minute revenue because our customer would respond to what product we offer or they offer. If they are giving, say, 5% airtime to jewelry, you can't extrapolate that to 100% airtime.
So now you are referring to per minute revenue. And what is the difference there between us and QVC?
So no, $60 per home per year revenue.
Perfect. $60 is per household per year.
Yes. And we are $3 per household per year.
Okay. Anyone in the middle between you two, any other player, and what would be his statistic?
So Evine and JTV are approximately $10 per household per year.
I missed the first name. Evine.
Evine. That is, they are called Shop HQ in US.
Shop HQ. And what do they sell?
So they sell a lot of watches, jewelry. So 40% of their revenue comes from jewelry and watches, and rest of them come from beauty and other stuff. They're called iMedia brands. So you can look, they're publicly listed. iMedia brands.
iMedia brands.
Yeah, and QVC is called Curate. I'm sure you already have the information on them.
Okay.
And the third is the Jewelry Television. That's a private company.
Yeah, that's
they are doing. Yeah, so their revenue is between $500 to $600 million revenue, and so I would say they're about $8 because they broadcast a similar number of homes as we do in US.
But JTV is purely jewelry, right?
They're purely jewelry, yes. So purely jewelry, they're between $500 to $600 million revenue from about 75-80 million homes that they must be broadcasting to. So they'll make it about $7.5-8 only from jewelry.
Okay. And iMedia would do jewelry and...
the jewelry watches is about 43% of their revenue.
Okay.
And rest is other products.
And they are also about $700 million, right?
So they were about $600 million as of last year. Recent quarter, they declined their revenue substantially because we had a change in ownership and new owners could not really run as well. So they have reduced their revenue run rate quite substantially.
Okay. Perfect. Thank you very much, sir. Thank you very much.
Sure.
Thank you. Next question is from the line of Pulkit Singhal from Motilal Oswal Asset Management. Please go ahead.
Yeah, hi. Hi, Sunil. Thank you for taking my question. Congrats on a good set of numbers. Just strategically, I mean, that chart was interesting that you shown the FY16 to FY20 kind of transition on product mix, on channel mix, etc. So just trying to take that forward to say the next 4 or 5 years. So would it be fair to say that jewelry as a proportion would actually come down from say 78% from the full year to 50% odd or 55% odd in the next 5 years? I mean, continuing the same trend as what you see in the US?
Projecting for 5 years for product mix is difficult for us. As I mentioned earlier, we let the product earn its space in terms of metrics productivity ratios we have in place. So we constantly monitor the metrics productivity ratio for hourly basis and also product category basis, buyer basis.
Sir, this is the operator. Sorry to interrupt, but your audio is not very audible, sir.
Okay, let me increase the volume. Sorry, I'm on mobile phone from US, so it may not be as clear.
Sir, your audio is sounding very muffled. Hello.
I'm able to understand. I don't know what you're doing.
Yes, even I am able to hear that. So, Sunil, you can go ahead. You are very clear.
Okay, sure. Janice, your audio is not sometimes clear to me also. All right. So what I was saying, Pulkit, is that we let the product category earn space in terms of our gross margin and also in terms of metrics productivity ratio per minute that we calculate. So I can't project what the ratio will be, but my intuition is that jewelry will slowly decrease as a ratio of total business. But every product that comes in has to find its place in terms of gross margin and productivity ratio.
Yeah, absolutely. I mean, I'm coming also from the perspective that even QVC long back would probably have a higher share of jewelry, and they've also somehow found jewelry to be a lower part of the mix as we stand. I'm saying over the last 15, 20 years. And to that extent, the consumer pull has been towards some of the other categories as well. So it seems just looking at your last 5 years, next 5 that would go down. But I just thought I'll get your comments on that.
Yeah, so that is a good assumption because I remember when I started selling to QVC about 25, 30 years ago. At that time, their jewelry was about 30%, 33%. Now they're below 10%. Because they found the new customer acquisition is higher in non-jewelry product. So jewelry is pretty low in terms of new customer acquisition.
Right. And similarly, continuing the theme on the channel mix, as the web platform goes up, is it fair to say, I mean, I understand that many of them may be coming online looking at the TV, but at least for the television, you're paying a content cost. And for web, I'm presuming the content cost or the cost of that platform will be a lot lower. So does that provide a huge amount of leverage as that share goes up?
Yeah, for airtime, if the cable cord cutting continues and goes rapidly down, then some contracts that we have on per home basis, or even the fixed contract when we renew them lower based on their home numbers, so that may go down. And some markets like OTA, which are increasing the number of homes, so that will go up. But in long run, there may be some savings there, but not meaningful. Our benefit will come from leverage afforded to us by revenue growth, where the costs are largely fixed.
Right, but for web, the platforms where you send online, there's no content cost out there. I mean, or very limited content cost, unlike a TV channel.
Except the marketing cost. The customer acquisition cost is there for new customer acquisition. For example, if you're doing digital ads, the display ads or PPC campaigns, there we have to pay per customer acquisition. Marketplaces, we have to pay as a percentage of revenue. Or say influencer, as that business increases, there's a percentage of revenue that will be given to them.
And that would be lower than your current pay TV content cost? I mean, whatever percentage of revenues that is going out, is it a higher margin channel is what I'm just trying to understand.
So it goes differently. For example, social DR that we just started recently, a few months ago, there the advertising revenue to Facebook is slightly higher because it is starting up right now. Right. But as we scale up, as we understand the business, it will go down. So there is a potential for additional leverage there.
Okay. And next question, I mean, your constant currency growth has been 14 to 16% in FY20. But, I mean, the depreciation of dollar to INR has been around 7 to 8%. So why are we not able to see that in the INR revenue growth? I mean, why is that not coming to 20, 22%?
The pound has devalued against dollars and rupee, against dollar. So when you look at rupee to pound, the INR has not devalued against pound. So that is the one of the main reasons.
So it's completely offset the benefit from dollar INR is what
I don't have exact numbers, but maybe Dipti and Vineet can do it later and share with you. So to some extent, and some of the other B2B sales have decreased year over year. That's why you don't see our total revenue growing by that much.
Right. Last question. I mean, the companies have been giving us an idea of how March revenue growth has been, because that is kind of like a one-off. and they have indicated as to how April and May is going. So if you could mention at least how Jan Feb together versus March was, so that we know what the run rate is and how April and May are showing up.
So I don't have exact number, but I remember March for US was about flat, slightly higher than last year. UK March was about 15% growth year over year. But I don't hold me to these exact numbers. So that is from my memory I'm telling you.
And April May have recovered to more or less or higher than the Jan Feb level?
Right, they have.
Okay. All right. Great. Thank you.
As I mentioned in March, so just to give you some color on that, in March we didn't have the new product coming in the full flow that we saw in April and May, while the return rates were higher. So that was the reason for subdued growth in March.
Right. So this is great. Thank you for answering my question, and all the best.
Sure, Pulkit. Thank you.
Thank you. We take the next question from the line of Aditya Mehta, from individual investor. Please go ahead.
Hello, Aditya. Yeah, good evening, sir. Yeah, sir, on one side you were saying that the lower price jewelry items are moving fast. And on the other side, we see in the presentation, the average selling price has increased. ASP of our products have increased. How has this is possible?
The change will be reflected in current quarter, Aditya. In Q3, as I mentioned, our new product inflow didn't fully come at the time. So we continued to sell in March, and in January, February, it was business as usual.
Okay, so in current quarter, we are expecting our ASP to come down.
Yes, to some extent.
Okay. And just one more thing, could you please give up the breakup between jewelry and lifestyle products in Q4, specifically for Q4 only?
Yeah, Nate, can you share that number if you have it?
Yeah, just one second. So jewelry sales in Q4 was 78%, so lifestyle was 22%.
Same as the annual figures. And one more thing regarding the finance cost, though it is very small number, around 4 crores per quarter, it has doubled if you see to the previous quarter. How is it possible even though the borrowings have remained the same?
So a part because of the accounting standard, a part of the exchange loss on the dollar loan is reclassed to this finance cost, and also because of the India's accounting standard which we mentioned. So we get a little benefit in EBITDA, but that's get partly compensated in this finance cost in the form of accounting standard reclass of interest for the leases. So these two reclassification, if you remove that, our finance cost is almost flat year on year.
Okay. Thank you. That's it from our side.
Thank you, Aditya.
Thank you. We take the next question from the line of Rakesh, individual investor. Please go ahead.
Congratulations on a very good set of numbers. So my question is, in your presentation on page number 9, you have mentioned that mobile sales contribute 60% of the web sales. So when I do plain arithmetic, then this mobile sales comes somewhere around 360 crore of the total sale. I just want to know whether these mobiles are branded mobiles like Apple, Samsung and all, or these are cheap mobiles which you are importing from China, Taiwan and all.
So I think you misunderstood this point. The mobile sales means sales through mobile platform. That means we track desktop and mobile as two separate categories of revenue generation.
Okay. It is like sales through mobile through app or something. Fine. And yeah. My another question is that we have approximately 63 crore rupees debt in our books. Is there any plan to repay this debt and make our company look debt free?
So this is working capital debt. So we have a large credit line in India and UK. and we are utilizing very small portion of that credit line, and we keep the credit line alive in case we need the financing in future. So as you will see, our net cash is net debt is negative. So that means we have substantially cash in our balance sheet. So we use small portion of that.
Fine, sir. Is there any measures we are taking for reducing costs? Because our cost structure is like we have a high operating leverage wherein fixed cost is very high. So in case of any eventuality or slowdown in the US or UK economy in future, so how are we preparing for that if we are doing something? Can you throw some light on that?
So cost reduction is our constant endeavor. We are a very low cost company compared to other players in US and UK. So that's a constant endeavor. And during pandemic, we're trying to be more frugal into the cost. But our large portion of our cost is manpower and airtime. For us, both are kind of fixed because of our business volume needs. And also we took a conscious decision during our lockdowns in China and during our lockdowns in India. We paid the salary for people completely without any reduction, even though none of people were able to work, especially the factory workers. So we took the decision and we paid full.
Fine, sir. Thank you. That's it from my side. Thank you.
Sure, Tish.
Thank you. Before we take the next question, I'd like to remind participants, if you have a question, please press star then 1 on your touchtone telephone. We take the next question from the line of Kapil Banga, individual investor. Please go ahead.
Yeah, thank you for taking my question. So I have 2 questions related to customer acquisition and customer engagement. The first question is around the unique customers that the company has. Though the numbers have increased as compared to the last year, but given the size of the market, the current market share that VGL has, there's substantial potential to increase it further. And we are doing customer addition looks below the potential. So are we innovating enough to bring in new customers within the core competencies? And what's the view? So this customer addition has increased. What's your view on this number going forward?
Sure, Kapil, thank you for your question. So you're right, the market is pretty large. But our principle has been prudent investment into customer acquisition, unlike many other e-com players. And no disrespect for their business model, they've done very well. But our strategy has been to prudent investment into new customer acquisition channels, whether it is through television, or by acquiring new channel positions, or through web marketing, by buying the customer, by spending large sums of money. So we look at constantly ROI. For example, I'll give you a background that the TV channel broadcasting cost, we have a cadence already set for every new market that we get in. So we have a cadence of 30 days, 60 days, 90 days, 6 months, 1 year, and 1.5 years. If any market don't meet that cadence, then we will have to exit that market. And for example, same for e-com customer acquisition. If a certain market, a certain strategy is not working, like keyword or certain display ad is not working, so we'll stop that. So if we were to burn more money, we can probably acquire more customers quickly. But that will be against our business model of constant 15 to 17% growth at EBITDA growth with operating leverage.
Okay, so I had a query more on the product innovation side. So I certainly see that product innovation, product pull would result in better customer acquisition rather than incurring more on channel cost or new or creative marketing programs. So on the product innovation side, the traction could have been better.
Yeah, so as I mentioned earlier, we air about 150 new products every day. So there's a lot of energy that goes into bringing new product in. And that is one of the key drivers of our revenue growth year over year in a competitive market like US and UK, while other retailers are not going anywhere close to that.
Okay. Okay. So second and last question again on customer engagement side. So I keep checking the reviews of Shop LC app on the Google Play Store, on the Apple Store. There's not much traction in the downloads of the app and the reviews that have been put. Though the share of revenue that is coming from mobile app is going up, as mentioned in your presentation, but the number of downloads and the number of reviews are moving at a modest pace.
That's a great observation, Kapil. Yeah, that's a great observation, Kapil. Thank you for bringing that up. So that is true that the mobile app revenue for us is relatively low compared to total mobile sales. So mobile sales is largely from responsive website or through browsers compared to the app. And so we are putting the initiative recently. Recently we hired a new CTO who comes with 20 years of experience on television e-commerce space. So he has put in a new vendor and a new team together, and he's continuing to build that team to accelerate our mobile app as well as the mobile engagement with our customers. So in coming years, you will see more robust growth and more rapid downloads into this space. But it will take time. So don't expect the next quarter, but it will happen a few quarters down the road and a few years down the road.
Okay. So I'll just squeeze in one last question. So the shelter in place in US has led to better growth for entities which have been providing online platform like yours, online and TV platforms. So was that a tailwind for you also for the month of April, or it was business as usual?
To some extent it was.
Okay, and in the absence of that tailwind going forward, as other offline channels catch up again, you see the growth moderating?
Since we have a lot of initiatives in place that has been there quite some time, we expect those initiatives to play and continue our growth even after this tailwind ends.
Okay. Thanks a lot for taking my question, and the response was really helpful. Thank you.
Thank you, Kapil.
Thank you. A reminder to all participants connected to this conference, if you wish to ask a question, please press star then 1 on your touchtone telephone.
So, Janice, we have to take this as the last question. Next one.
Well, ladies and gentlemen, that was the last question for today. I would now like to hand the conference back to the management for their closing comments. Over to you all.
So I want to thank all the participants in the Q4 investor conference call. Once again, I reiterate my immense confidence in our robust business model that does very well in good economy as well as in adverse circumstances as it is currently. Finally, I wish you and your loved ones lots of health and safety. Feel free to contact Deepti Rajput or CDR if you have any further question that we can help you with. Thank you and goodbye.